Hello, welcome all to our financial insights and discussion channel. Wishing you all a very happy new year 2026. I'm CA Nileshware. I would like to share with you the various financial key concepts and the unique nature of the businesses, how they operate. Today, we will cover one of India's oldest company story whose name is Larsen and Toubro, and this company is working since more than 80 years. It has reported a turnover of 2.25 lakhs crore and profit of rupees 15,000 crore in the last financial year ended 31st March 2025. So let's begin our story with L&T. So first, business of Larsen and Toubro. Building a future-ready world. First, they build the foundation, that is infrastructure. Imagine a city with no roads, no trains. Now, L&T starts here by building the skeleton of the country. They build the tracks on which you ride and the bridges which you cross. Example, when Mumbai needed to move faster, L&T went underground to build the Mumbai Metro Line 3. Then they power the city, that is their energy business. Once the roads are ready, the city needs power and fuel to run. L&T builds a giant engines that provide electricity and petrol. Example, they install massive refinery units like 1700 crore vacuum unit that turn raw oil into fuel that runs our cars and buses. Then next they protect and reach for the stars, that is high-tech manufacturing. A great nation must also be strong and curious. L&T uses precision engineering to build the toughest machines. They make sure the country is safe and hence they also explore the space. Example, they built the launch hardware that sent Chandrayaan to the moon and created advanced submarines to protect our seas. Now they add the brains, that is IT and engineering services. In 2025, a city is not just made of concrete, it's made of data. L&T provides digital brain to make everything smart. Example, through LTI Mindtree, they created the software that runs global businesses, and through LTTS, they help design the smart cars of the future. And finally, they empower the people via digital and financial services. A city is nothing without its people. L&T completes the circle by providing the money and digital tools people need to grow. Example, through L&T Finance, they provide farmers loan to buy a tractor or a family a loan for new home, making sure everyone can participate in the story. So, from underground deep tunnels to the satellites high in the space, and from software in your phone to the loan for your first home, L&T is there building every part of our lives. Now, I hope you are pretty well aware about their businesses. Now, let's see their revenue recognition model as per Indian Accounting Standard 115 on revenue recognition. The logic of control transfer. L&T follows accounting standards that state revenue is earned when the buyer effectively becomes the owner and assumes the risk of ownership, not necessarily when item is physically built or when payment is received. I will repeat it again. L&T follows accounting standards that state revenue is earned when the buyer effectively becomes the owner and assumes the risk of ownership, not necessarily when the item is physically built or when payment is received. Scenario 1. Selling standardized electrical gear. Imagine L&T sells a batch of standard electrical switchboards to a factory owner. L&T builds the product. The items are on L&T's premises. If a fire breaks out, L&T bears the loss. The items are L&T's inventory. No revenue is recorded because it is in his premises. So how a customer will bear that loss? Now suppose L&T delivers the switchboards to the customer's warehouse. The customer signs the delivery receipt and takes possession. So now control has been shifted to the customer. At this moment, control is transferred to customer. The customer can now install, use or even resell the gear. If the gear is stolen from customer's warehouse, it is their loss and not L&T's. At this moment, revenue is recognized. L&T recognizes 100% of that sale as revenue immediately because the performance obligation, that is delivering the item, is complete, and that's it. Now scenario 2, supplying a large specialized machine. Consider L&T supplying a complex piece of equipment like a chemical reactor that requires specialized installation. The contract might state that L&T is responsible for not just manufacturing but also installing and successfully commissioning the reactor at the customer's plant. In this case, control does not transfer upon physical delivery to the site. The customer does not have full control until the machine is installed and that machine passes all the operational tests. Only after L&T completes the commissioning and the customer provides a final acceptance certificate, then only L&T recognizes the revenue. See, the core logic is consistent here. Revenue follows control. L&T books the income when the job for a specific item is truly done and the responsibility shifts to the client. Let's take another real example. In the world of L&T Energy Hydrocarbon, imagine the company wins a high-stake contract to build a massive offshore wellhead platform in the deep waters of the Arabian Sea for a client like ONGC. Because the ocean is unpredictable and technical specification might evolve during the multi-year build, they sign a cost-plus agreement. Once L&T begins fabrication, the financial story unfolds month by month rather than waiting for the final delivery years away. Every time L&T buys specialized steels, pays for thousands of engineering hours or pays heavy rents, these are recorded as recoverable cost. Since the client essentially owns the progress of the platform as it takes shape on the yard and later at sea, the control is transferred over time. To determine the revenue, L&T takes these actual costs and adds the agreed margin. For example, if they have spent rupees 200 crore this quarter on subsea pipelines and labor and the contract specifies a 10% margin, they would recognize rupees 220 crore as revenue in their books immediately. This process ensures that company's financial health accurately mirrors the physical reality of the steel being welded and the platforms being installed, providing a steady and transparent view of the growth to the public and investors. So revenue is recognized as work happens over time because the client gives value as the project grows. So total revenue is equal to recoverable cost on steel, labor, equipment plus agreed margin, that is L&T's profit fee. This method prevents sudden surprises in the financial reports by showing steady progress and ensuring L&T is paid for the real effort they put into complex infrastructure every single day. Now, second category is fixed price contract. So, to explain the fixed price contract in L&T's world, let's look at a story involving a massive infrastructure project like the construction of high-speed rail bridge. In this scenario, L&T agrees to build a bridge for a fixed price of say rupees 1000 crore. Unlike the previous cost plus model where the price can fluctuate, here the price is locked in. Even if the price of cement or steel goes up, L&T must deliver that for only rupees 5000 crore. As L&T begins construction, they use the percentage completion method to tell their financial story. They don't wait for the bridge to be finished in 3 years to record the money. Instead, they recognize revenue based on how much of the total mountain they have climbed. If L&T estimates the total cost to build a bridge is rupees 800 crore and in the first year they have spent rupees 200 crore on foundations and pillars, So then they have logically completed 25% of the work, that is 200 divided by 800. Now, because they are 25% done, they are now entitled to recognize 25% of their total 1000 crore contract, which comes to 250 crore in revenue. This revenue includes the actual cost spent 200 crore plus a proportionate margin 50 crore in the expected profit. By doing this, L&T shows the public that they are transferring control of the bridge to the client pillar by pillar, and it ensures that the company's income statement reflects the massive physical effort happening on site throughout the year rather than showing a blank year with no income. Progress is measured by the cost of work performed compared to the total estimated cost. So revenue is recognized by taking percentage and applying it to the total price. This method captures both the cost and the profit step by step, providing a transparent view of how much value Realty has added to the project during the year. Now for their property development division, think the beautiful L&T Sea View luxury apartment towers. The story is different. They don't book revenue while the concrete is being poured and the walls are going up. They wait for the climax. Now you will see what is the climax. Imagine they have spent 2 years building the towers, carefully tracking all the costs which are sitting on their balance sheet as assets. They have contracts signed with the customers and they are reasonably expect to collect all the money from their buyers. The big moment arrives when they receive the OC, that is occupancy certificate, from the municipality, polish their lobbies and get ready for the handover ceremony. Their performance obligation is not satisfied until that specific key is handed over and the customer can physically walk into their finished home and call it as their own home. At that exact point in time, control of the property transfers completely to them. That single moment is when L&T records the entire sale price of that flat as revenue. This logic means the property financials appear lumpy. Some years will show very little revenue while building, and other years will show massive spikes when hundreds of customers finally get the keys to their dream home. So for cost plus contract, L&T recognize revenue over a period of time using percentage of completion method, whereas where the revenue is recognized each period equals the recoverable cost incurred plus agreed margin. So this approach is used when, because customer typically gains control over the asset as it is being constructed, and the company has enforceable right to payment for the work completed till date. Now let us see another example to make the things more clear. Imagine L&T is building a massive sea bridge for a city. Instead of waiting years until the bridge is finished to get completed, they use cost plus agreement where city pays them as every work. Every month L&T tracks exactly what they spend, like the steel use, engineer salaries and the fuel for cranes. Because the city owns the bridge, even while it is half finished, L&T recognizes over the time because these are based on real-time efforts. They take these monthly cost, that is recoverable cost, and add the agreed upon profit, the margin, to determine their total revenue for that period. For instance, if they have spent 100 crore this month and their agreed profit margin is 10%, they report 110 as revenue immediately. This logic ensures L&T's financial report actual work happening on the ground every day, showing the public and investors the total value that is being created and earned step by step rather than for all once at the very end. In the L&T industry, particularly for high stakes project like Mumbai Coastal Road or an offshore hydrocarbon plant in the Middle East, cost plus contracts are used when the scope is too complex to fix a price upfront. Now again, let us imagine that L&T is hired by major oil company to build first of its kind offshore platform. Because underwater conditions are unpredictable, they agree on a cost plus incentive fee model. Every quarter, L&T tracks every rupee spent, thousands of tons of specialized corrosion resistant steel, high tech subsea sensors, and the hours logged by deep sea divers. These are the recoverable cost. As per their agreement, L&T adds a 10% management fee on the top of these costs for their expertise. If they spent 500 crore this year, they recognize 550 crore as their revenue. Now suppose L&T hits a technical milestone like successfully installing the platform's jacket ahead of the monsoon. They might earn extra bonus, that is incentive fee, which is also recognized as revenue because the value was delivered to the customer. Under the Indian accounting standards, that is Ind AS 115 on revenue recognition, L&T does not wait for the platform to be fully operational in the ocean to claim success. Because the oil company owns the work in progress as it is built, L&T recognizes revenue over a period of time. This approach prevents lumpy finances instead of a zero revenue year followed by a massive spike at the end. Company books show steady, transparent growth that matches the physical progress of the project. In a fixed price contract, L&T agrees upfront to build a complete asset for a single set amount regardless of what their final cost might be. The customer still gains control as the work happens, so L&T recognizes revenue using the percentage of completion method. This means they estimate how much of the job is done and bill a proportionate amount to the of the total contract price. The recognized revenue includes both the cost incurred and the proportionate share of the estimated total profit. Let us see L&T Smart City project. Imagine L&T is building a new smart city utility grid for a state government client. So total fixed price is 100,000 crore, estimated cost is 800 crore, so estimated profit would be 200. So L&T would not wait for that city to be get completed. As and when it incurs cost, it will go on recognizing that revenue as per this cost plus contract. Now, in the property development scenario, revenue recognition works differently. For L&T, imagine they are building a large premium residential complex called L&T CU apartments. So again, as we talked now, they have to give the possession only after that occupation certificate is ready and the customer gets the final possession of the flat. Then only that company, that is L&T, can recognize the revenue. Now let us see how revenue is recognized in their last segment in our discussion, which is when L&T steps away from heavy construction and moves into high-tech maintenance or engineering consultancy services like managing the complex digital signaling for a metro line or providing specialized technical support for a refinery. The way they earn the money shifts to a more fluid continuous story. Imagine L&T has signed a 5-year contract to provide 24/7 technical monitoring and maintenance for a massive city power grid. Now, unlike building a bridge where you see a physical structure grow, here L&T is providing an ongoing service. As every hour passes and every day ends, the city is simultaneously receiving and consuming the benefits of L&T's expertise. Because the city is constantly safer and the grid is constantly running due to L&T's work, the performance obligation is satisfied over time. The logic is very simple. If the city were to suddenly cancel the contract tomorrow, they would have already enjoyed 5 months of stable grid that they don't have to return. Therefore, L&T has an unforeseeable right to be paid for exactly what they have delivered up to that date. Finally, L&T recognizes revenue steadily, perhaps monthly or quarterly, rather than waiting for the end of 5-year term. This ensures that as long as service is being rendered and the customer is benefiting, the revenue flows into L&T's books as a reflection of their daily commitment and ongoing value. So, summary of revenue recognition for services. The consumption, the customer like a city grid benefits from the service the very moment it is provided. L&T earns legal right to payment for every day of work completed, meaning they don't have to wait for the final product. Revenue is recognized over time, creating a smooth and predictable financial story that mirrors the constant support L&T provides to the nation's infrastructure. Let us take another example to understand better. In L&T's universe, imagine a smart world and communication business unit wins a long-term contract to manage integrated command and control center for major smart city. So they are not handing over a physical building; they are providing brain to the city that is managing the traffic sensor. So this is the same that we have discussed right now. So basically, this is how revenue is recognized in different nature of the businesses. I hope you really liked this video. Kindly do send your feedback to improve the contents and the flow of the video and the channel. And thank you and goodbye and have a very happy new year 2026.